Hello and welcome to Ticker Tapes. Today, we're taking a look at the world of high-growth stocks. Having read his own obituary in the papers, author Mark Twain is said to have quipped, "Rumors of my death have been greatly exaggerated." The same could perhaps be said of high-growth stocks after last week's astounding rally in the Nasdaq 100 and composite indices, each of which made gains of 7.5% over the last full trading week in June. The S&P 500 information technology sector added 8.34%, whilst RPG, the Invesco S&P 500 Pure Growth ETF, rallied by 7.83%. Why the gains? Well, the market senses that the Fed endgame is in sight and that U.S. interest rates will top out at 3.5% and will do so by December as inflation comes back under control. Technology and growth shares were previously pricing in a worst-case scenario, a sort of nuclear winter for disruptive stocks, and for the moment at least, that's no longer the outcome the market expects, and so a re-rating ensued. The highest rated and hardest hit growth stocks were the same names that rebounded the most vigorously. DDOG Inc. rallied by 31%. OTKA Inc. added 28%, whilst Atlassian's stock price jumped 25% in the space of 5 trading sessions. It's worth noting that there were only 2 Nasdaq 100 stocks that didn't post weekly gains, and there were no losers at all among the stocks within the S&P 500 information technology sector. Citigroup analysts published research on Friday which noted that the valuations of software stocks were at or near multi-year lows and that the de-rating of the sector was mostly done, though they still cautioned investors to take a more defensive stance and hold stocks such as Microsoft and ServiceNow as they are most exposed to resilient IT spending budgets. The bank's picks among other high-growth stocks included MongoDB, Fortinet, and CrowdStrike. All of the Nasdaq 100 stocks were trading above their 5-day moving average at the end of last week, but only 33% of those same stocks were above the 50-day moving average, and only 14.7% were above the 100-day line. This suggests one of two things. Either there is further upside scope for tech and growth stocks from here, or, as impressive as the rally has been, it's nothing more than a short-term correction, and further catalysts will be needed if these stocks are to claw back more of their 2022 losses. We are around 1 month away from the start of Q2 earnings seasons, and any positive surprises from tech and growth stocks, particularly around pricing and the outlook for the second half of the year, would be gratefully received by the market, we suspect. Wall Street analysts have cut their forecast for information technology stocks by 3.5% over the current quarter, and they are predicting the poorest earnings performance since Q3 2019, when earnings fell by 5.1%. As such, they have set a very low bar, one that wouldn't be that hard for the sector to beat if things in the real economy aren't as bad as were painted just a few weeks ago.